Okay, welcome everybody to today's presentation on investment strategies destroying the red tape reduction strategy. Now, why have I called that, or why have I given our presentation that subject matter today? Well, pretty simply because a lot of the talk out of government over the past probably 10 years is about what we can do to reduce the red tape in the SMSF space. But coinciding with all that has probably been a greater emphasis on what the investment strategy of a self-managed super fund looks like. And so what that has resulted in is that we need to take a great deal more care with regards to the investment strategy and what it actually means. So, it's give and take a little bit with offsetting some red tape requirements with clearly a little bit more requirement around the investment strategy. So I'd like to introduce you to my co-presenter today, Tom Davies, our Associate Director and Senior Client Manager here at SuperGuardian. Tom, welcome along.
Thanks for having me, Tim.
And for those that are following along and paying attention to our invitations and tweets and things about this, Josh Williams was meant to be joining today, so I appreciate Tom jumping in at last minute to join me. Josh is a little unwell, so our best wishes and thoughts are with you, Josh, until potentially partway through this presentation, and then we'll see how we're thinking about you at that point in time. So anyway, let's jump into it. Obviously, our standard disclaimer, but what I want to focus on today and what we want to discuss a little bit here is, I guess, the issues of where the investment strategy sits in the SMSF space, what we're actually trying to achieve out of the investment strategy. I kind of wind up a little bit at the end of the presentation with really the impact of 2020, and we look a little bit in the rearview mirror to see some of the key issues associated with self-managed super funds that can be directly impacted by a fund investment strategy. So, it does provide us with a timely reminder of what we're doing there. How an ineffective or inappropriate investment strategy can lead to multiple compliance issues. And, we don't really have the capacity today to go through all of those compliance issues, but we'll take a broad brush view of some of those key things to contemplate. And look, then we'll also, through our general discussion, we'll talk a little bit about the old off-the-shelf investment strategies, because overall investment strategies have come a long way. I find that today's presentation, we actually ran it as a session, internal session recently, and it was quite conversational. So please, if you've got any commentary or questions to ask, make sure you put them in the Q&A box, and we will address them as they come through, even if they're an area that I'm going to go through in some form of detail afterwards. So look, what I wanted to start with is this idea that SMSF trustees have effectively this cognitive balance or bias. So what am I referencing when I'm talking about cognitive bias? And don't worry, I'll get to my imagery in a moment for you. But really, what I'm trying to address, or what we need to address, is the fact that trustees are influenced by everything around them, like all of us. And it's that whole confirmation bias. It's the prejudices that we see in the way that things are presented to us that make us make often rash decisions, but sometimes very successful decisions as well. But really, there's that requirement on us, or that need for us to take those biases, take what we're seeing, be it on social media, through the news, or wherever else it's coming from, and turn them into positive messages, but also ensure that our fund and our investment strategy is reflective of actual research that we've done. And I think probably, and I actually avoided putting a picture of Bitcoin on this slide, one, because I'm going to talk a little bit about Bitcoin in our next presentation on various types of currencies and collectibles. But I think Bitcoin is a classic example of cognitive bias, Tom, where you see at the moment that a lot of people are going, wow, this is something it's valued at 67,000 Australian dollars. It was at a couple of $1,000s, 10 years ago or whatever. I've got to get on board. So, well, do you understand it? Do you understand crypto? I can ask you, Tom, do you understand crypto?
Not really, Tim. So it's not part of my investment strategy.
No. And look, you know, many years ago in a former life, someone asked me, Tim, what do you know about cryptocurrency? And I sort of said, well, it's a little bit like monopoly money without the board. But that was basically my entire knowledge at that point in time. So I did my research, became a much better monopoly player out of it. But I did my research and ultimately, you know, got at least an understanding of where it sits in the investment market. I've got to say, I still don't understand what blockchain means, but that's one of those areas that we need to understand. So, you know, when we look at the cognitive biases that people have, it's not an issue necessarily, but then is it reflected in the investment strategy? Now, what I would say is, what did these SMSFs have in common? And what we've got there from an imagery point of view, for those playing along at home, we've got a picture of an ostrich. We've also got a picture of moon rock, and we've got a picture of a toilet block. Now, these three images represent funds that in my time in self-managed superannuation funds and self-managed super education and administration, I've seen funds that have held all of these investments. I also know that in the example of the ostriches, all of those funds lost a lot of their investment money. Now, we're talking about the late 1990s. 1990s, people were investing in ostriches and ostrich farming. And of course, a lot of people were left ultimately, and I apologize for this, but with slaughtered ostriches at the end of it. So they effectively lost their investment. But, you know, it was touted as one of those next best things. Now, Moonrock, for example, there's a little bit of an interesting investment that I've seen inside a self-managed superannuation fund. To designate or recognise something as Moonrock, there are tests that can be performed. From previous trips to the moon, we have brought back Moonrock and they've done analysis of it. And so there is some value on it. But I'll tell you what, if you go onto eBay, you can find bits of Moonrock anywhere on there for $8 up to $1,500. And you can find articles where people have sold Moonrock for 2.5 million. So, you know, how are you incorporating that into the investment strategy? And similarly, with the toilet block there, are we talking about business real property? We know that some business goes on in the toilet block, but what is the returns? What are we looking for with regards to making an investment, like an investment in a toilet block, and have we actually thought it through? And I think if you look really closely at that image, you might be able to see Josh in there somewhere. But you know, I don't want to talk too much about his absence today. But thoughts are with you, of course. So one of the things that all of these self-managed super funds had in common was that they had a generic investment strategy, right? So they did not actually think too hard about it. They had the old standard off-the-shelf. My super fund is going to generate CPI plus 2% over any rolling 3-year average period, and I'm going to consider the risk, the liquidity, the diversification, and the ability to discharge my liabilities. And we as an industry accepted that, right? And I think particularly people like myself who have been on the public record for many years talking about investment strategies, I'm the first person to put my hand up and say that I used to make the comment quite regularly that investment strategies weren't worth the piece of paper they were written on. And I know, Tom, you and I have had this conversation a little bit as well. And that is that historically we've effectively had almost this confirmation bias, for want of a better term, that because it's our own fund, it's our own self-managed superannuation fund, the investment strategy is irrelevant because it's our fund, it's our money, we know what we're doing. And I think administratively, I even think from a regulatory point of view and from an audit point of view, there was that blasé attitude towards it for a long period of time. But now I think more so we have this willingness and this preparedness to embrace it and use it for what its intended purpose is, and recognizing that it's a far more fluid and I guess liquid in document, for want of a better term, than the trust deed. So the trust deed governs everything that we can do, and the investment strategy ultimately is more mobile in how we go about doing things. And I'm not sure if you've got any commentary. I mean, I guess from an admin point of view, you've certainly seen a lot of investment strategies in your time. What would be some comments you've got in regards to that space, Tom?
Similar to your comments there, Tim, that it has become a bit of a box ticking exercise, and every fund needs to have an investment strategy. So generally there's not a lot of thought put into the document, whereas there's quite a lot of thought put into the actual investment. So my point of view was similar to yours, where in the past, the document is basically worthless because it's just, completing a checkbox for the auditors. So, and we see investment strategies come in that either aren't completed correctly, they're not fully completed, they're missing information, and generally that's just going to throw up audit issues and delay the audit process. So when the advisors or the clients are putting this thought into what they're going to invest in, that's what we want to see in the document, not just okay, we need an investment strategy, we're going to tick the box on the template and send it back to the administrator.
And what you were telling me, about that client with was it gold or something? What was the conversation you were having the other day?
Yeah, so this client rang up and was going to be investing in gold and spoke at length about the reasons for doing it, where the government's at the moment, where the stock market's at, and property, etc. So that their goal was to invest in gold. And when they sent the investment strategy template back, they just ticked the box next to 100% cash. So you sort of shake your head and go, well, exactly what you said on the phone was what they should have put down on the investment strategy. And that would have been a perfect strategy that would have lasted them for as long as they needed it to.
Yeah, and look, and I think that's the point, and certainly the messaging that we want to try and get across from today's presentation is there's somewhat of a process to go through, and that thought process is key, is critical to what we're trying to achieve. But then it's the last part of the process that we all struggle with, or historically have struggled with, and that's the documentation side of it. So look, I wanted to, I guess, chuck a couple of ATO statistics up, just to give a bit of a look and feel as to where the industry has moved to. And of course, we get the quarterly stats, but the annual statistics that the ATO provide are certainly far more thorough, and no better have been the stats that they released last year. And clearly what we're seeing here is that from the 17-18 year, which is the last full year that they were reporting on, there is clearly this indication that people are starting off, like over a third of funds are starting with a sizable balance. So that gives them a greater capacity to invest or diversify their investments right from the get-go. And if we look at it, and I've got another slide on diversification a little bit later, but we know that those funds that do set up with sort of $0 to $100,000 or $0 to $50,000, they will be heavily investing in cash up front because they haven't really got the capacity to go too much broader than that. But there is that ability for people to at least be contemplating the investment strategy. And I think, to me, as we talk through the process, the investment strategy is the first document that we create in the SMSF environment based on how much money we believe will be put into the fund, into the environment. So we've got to set effectively our objective and our plan to get there. It's not going to take long then to do that first review, because you'll get a year in, or whatever it might be, into the fund, into your initial investments. You've made the capacity, or had the capacity to make more contributions. And so therefore you want to start reviewing, okay, I've got more money, or that's not quite generating what I want. So we go back and look at it. But I think, the scalability is certainly there early enough now for people to start to create a more meaningful investment strategy right from the beginning. And I think this was a key point. And the age distribution of SMSF members when they set their fund up. And look, what we can see from this stat, I think that the clear thing here is that the average member age is roughly 46. So even though the majority of funds starting up are that 35 to 44 age bracket, the average age is 46. And I think that reflected a little bit some of the stats that we sort of record, Tom, that you and I were talking about before.
That's right. So our direct client groups, they're slightly above the ATO average, so around the 47-year age mark, and whereas our advised clients are slightly higher, again, between that sort of 48 to 50 mark.
Okay, that's interesting. I mean, and without us sort of sitting back and dissecting that too much, there could be a little bit of best interest duty from the advised side of things, where people say, okay, well, we need to work out if this is the best thing for you, whereas the younger non-advised clients are effectively making their decision based purely on confirmation bias or something else, or some other sort of consideration. Now, what's interesting is that we talk fairly heavily now from an age demographic point of view of how millennials particularly are moving into that age bracket where they're starting to get some asset backing behind them. They're looking at the SMSF as a potential opportunity. Your super, your future requirements, where you can effectively staple your employer contributions to a particular fund, may give some sort of tendency towards people approaching self-managed super funds early. I suspect from a balance point of view, they'd only do it if they join the family fund, and we'll touch on that as a bit of an issue a little bit later. But I think not too dissimilarly to myself, Tom, your kids are maybe slightly younger than my son, who is in that next demographic, which is Gen Z, and they are approaching, or he is approaching 18. So he is approaching the age of trusteeship as such. Now, I don't know if you want to reflect or reference your own children, but do your kids know more than you already?
Well, my kids are slightly younger again, Tim. So my eldest has only just turned 13. So I've got a teenager in the house now. But yeah, he's a lot more worldly in regards to computers and the electronic side of the world.
Yeah.
And they're learning about it in school every day, whereas back when I was at school, I think we only had 5 computers in the entire school. So things have definitely changed in a relatively short amount of time.
Correct. And look, and I think that's a key issue because what it does, and what we were talking about the other day, is what went on through the world with that GameStop or whatever it was called, was a little bit of, it was a rebuttal of the system. And it was generationally driven to a large extent, of people saying we want to do things a little bit different. And I think we're having to see that from an evolution point from a self-managed super fund investment strategy, is that particularly if we contemplate 6-member funds and other areas, and again, I don't see necessarily high take up in that space, but if we contemplate adding children to self-managed super funds, then when we look at these life cycle events as such, the admission of members is going to be one of those key and critical sort of review points that we need to start to contemplate. And when I look at the life cycle of the fund, establishment is clearly the first point from the investment strategy point of view, but it's also pre-establishment. One of the things, and I know many of those in attendance today would have come across scenarios in time where they've had clients or they've heard of clients who go out on a weekend, go house hunting for whatever purposes. They might see a property, they then, for whatever reason, put a deposit on that property, and then they contemplate, well, I could put this property in my self-managed superannuation fund, albeit that they often don't have a self-managed super fund at that point in time. But even if they do, they go, this could be an asset that I could put in my self-managed super fund. Where realistically, what mindset we have to try and create in our industry is one where a client has created their investment strategy, has identified property as a key target of their investment strategy for them to meet their objectives, and then they go out and they go house hunting and put the deposit down for limited recourse borrowing arrangement purposes or whatever else, not the reverse. And I think historically, like the emus, like the moon rock, like the toilet block, we have made the investment decision not in contemplation of the investment strategy, but almost despite or in spite of the investment strategy. And I think that's an area that we need to be mindful of. But just clearly having all of these key issues around the admission of members, around accumulating wealth, and maybe having some more illiquid assets in that accumulation phase versus the retirement phase. And you were saying to me that there's one thing that's very noticeable from an admin point of view with regards to that retirement phase issue that you picked up on.
Yeah, and quite often we see members go into retirement phase, or there might be one of the members in a multiple member fund, and the investment strategy doesn't change. Now, I would assume that when a fund goes, or when a member goes into pension phase, then there has to be some sort of liquidity to make sure that we can pay out the pension payments. And I think you've always said a good rule of thumb is to have 2 years worth of minimum pensions sitting in there in cash. And and this is only generally speaking, you know, like I said, we don't see the investment strategy change when there's a significant event like that.
Yep.
And along with other significant events, so if there's, like I said, an admission of a member, or if a member leaves for whatever reason, if there's a separation, death of a member, incapacity of a member. So there's all these things that happen throughout the life cycle of the fund.
Yeah.
And we would generally like to see some sort of thought process then go into the investment strategy when those events happen.
Yeah, and look, and I think that's, you know, that rule of thumb, that 2-year rule, you know, I can't claim it as my own. I'm sure someone a lot wiser than me probably suggested it from an advice point of view many years ago. But, you know, if you mirror stuff as well, then what we have to understand is that the whole issue around pension payments, you know, would have been something that was on top of people's mind at the start of the pandemic as such. So it's one of those issues for people to be mindful of. So yeah, I think it's that whole concept around where people are within the life cycle, and that the investment strategy must follow through and flow through that process for them. Now, look, what I don't want to do, or I don't want to spend a lot of time necessarily talking about the trustee covenants as such. But again, when we send out everyone the slide package after the presentation, I want them to have the covenants there and available to them to review. But of course, the key issues, and I've bolded them there, is our requirement to formulate a strategy, to review it regularly, and then to give effect. And giving effect is ultimately us bringing it into effect. So not just having it, but then living it and enacting the strategy. And of course, the requirement for us to think about the risks associated with it. And I'll touch a little bit on that diversification point, and where the ATO sort of covered off on with regards to their LRBA audit that they did of the singular asset strategy. I'll touch on that a little bit later, but there's no issue with that. But you've got to at least contemplate in the investment strategy the risk associated with that. All right. So if you choose not to diversify, then identify what are you exposing the fund to by not diversifying. And these are the areas that I think historically we really haven't covered off on very well. And, you know, what capacity do you have to turn those investments into liquidity if you need it? And I think in many respects, to go back to the start of the COVID issue, and then say the minimum pension relief, one of the key issues there is that we have this fixation, and I never know whether to be positive or negative about this fixation, but we have this fixation with protecting our capital inside the super space. Now, we all appreciate that, but we also recognise that superannuation is not an estate planning vehicle as such. Ultimately, it is. Ultimately, it becomes an estate planning vehicle, but its purpose, its sole purpose, is to provide the beneficiaries with income in retirement or attaining age 65. Paying a death benefit is supplementary to that. It's an ancillary benefit unless you die prior to 65, prior to retirement. So we've still got to recognise that preservation of capital is more of a mindset than anything else, because our obligation is actually to pay it down. And in theory, so it's not a great theory, but the theory is that on our final day, we draw the balance down to nil. Right now, we know it doesn't work that way. So we have to contemplate that. But then we've also got our other covenants to think through, and the regulations take the standard SIS covenants and provide us with that requirement to consider insurance. And I think that was, again, if we go back to the concept of paying lip service to the investment strategy, which I was a relative master of, let's say a decade ago, when that insurance covenant came in, you know, a lot of people were questioning, well, what does that mean from an investment strategy point of view? And, you know, there was the commentary around it was, well, what it means is add a sentence to your investment strategy that says you've considered insurance. Now, the mindset should be, okay, well, have you considered insurance? What are your insurance considerations for you and your family? Do you have insurance on the outside? And a little bit like the gold conversation, document it, right? So it's a little bit about sort of saying, what can we and what can't we do in that sort of position. And so, you know, I think there's some things to be mindful of. And probably for me, whilst it's a little bit separate from the investment strategy, it's all tied in around the same sort of regulations or similar area, which is around the separation of assets. So when we are contemplating the investments of the fund, you know, we have to identify that certain assets are easily registerable for the super fund, and so we can identify them in the name of the trustees. Other assets, Moonrock, classic example there, may not necessarily be as easy to put some form of trustee title on. Right, so this whole separation of assets is a pretty critical area. And I have the point there about corporate trustees and the imprudent nature of using an existing company to act as an SMSF trustee. It's not a legislative issue, right? So legislatively you can do it. And the covenants don't really cover off on this, or the regulations don't really cover off on this, because they talk about separating assets from your assets held personally. But if you've got assets in the name of that company and it's a trading company or an active company for some other purposes, then you ultimately are risking the assets of the superannuation fund by having the same corporate trustees. So even just, you know, the assets, the way assets are titled, the way assets are maintained separately can be incorporated and form part of this broader investment strategy document. And again, the whole ownership of the assets and the way that the names appear, one of the most regular contraventions or at least breaches that are brought to our attention from the auditor is separation of assets. But through conversation between myself and all our client managers, is what it often is. It's actually dissatisfaction with the naming conventions that are being used. So the assets are titled in a certain way that there's clearly separation between what they hold personally and in the super fund, but they might have changed from individual trustees to corporate trustee or corporate to individual, and the assets reflect not the correct names. Now that in itself is a separate issue to separation of assets. That's an administrative responsibility. And our administrative responsibility when we change the trustee is to notify the tax office of the change of trustees, right? Notify ASIC if we've got a new company or a change of directors. There is no covenant, there's no regulation that says we have to change the asset titles. It's more, you know, in that school of common sense. And that's often where we fall down administratively, is that we allow things to drag on and take their time. And so what we need to determine is, okay, should we be looking at a trustee declaration or some form of declaration of trust from an ownership point of view that recognises the asset ownership, but do everything possible to reflect the actual names of the trustees? Because one of the key messages that comes out of it for me is that, you know, if Tom and I are the trustees of Self-Managed Superannuation Fund together, that'd be living the dream, I think, would be the name of our self-managed super fund. But if we had a self-managed super fund together and then I left that fund, right, but I stayed on and Tom hadn't done anything to change the asset names, well, what's not to suggest that I can't go in and transact on those assets because my name's there. You know, I'm a signatory on the account. And if I've been a bit blasé in the way we've set some things up, you know, what if I sell those assets? What if and I pocket the money? So, you know, there's a whole best interest duty from the trustees that are actually the trustees of the fund. But once I've left the fund, I don't have any duty to anybody. And so we really need to make sure we cover that. And I know that it is a bit of an audit issue for us.
Yeah, it's one of the things that does hold us up in audit from time to time. And like I said, it's generally where there's been a change to the trusteeship, and that might be the admission of a new member. So there's another individual trustee that should be put on the bank statement or the share registry holding, or like you said, a change from individual trustees to a corporate trustee. And the naming might still be individual trustee ATF, the super fund. So it is clear that it's still a super fund asset, but the auditors do want to see the correct name on those asset holdings. So yeah, like you said, it's just one of those administrative things that can hold up the audit process more than anything.
Yeah, and it looks interesting and if I sort of sit back and think about that from an administrative point of view, and as a trustee of my own self-managed super fund, and I moved from individual to corporate trustees, and it was painful. It was a painful exercise to go through. But if I'm regularly reviewing my investment strategy, it means I'm regularly looking at my investments as well. And so we should be able to note those things at that time and go, okay, well, here's an area I need to address. Here's something that needs to be fixed up. And so we can look to address it there. So I think it's that whole separation comes into it. And look, what I also wanted to sort of highlight very quickly was that last week, the government introduced this Treasury Laws Amendment Bill, Your Future, Your Super, and it imposes this obligation on trustees of super funds to act in the best financial interest of the beneficiaries. Now, all it was is an addition of a word. Right? So all we've done is we've taken the obligation of trustees to act in the best interest of beneficiaries to act in the best financial interest of beneficiaries. And the purpose of that is really to clarify, and for me here, this is where I'll link it back to the sole purpose test, clarify that the financial interests rather than the non-financial interests are the determinative factor in the way we act as trustee of our self-managed super fund. And so the link back to the sole purpose test, and I'll touch on this a little bit in a couple of examples as well, is that the sole purpose test says we can have incidental benefits. Right? There can be incidental or minor current benefits to the beneficiaries of the fund via the investments that we undertake. However, that can't be the reason we invest in it. Right? The reason we invest in it is to provide for the retirement benefits of the members, to provide for the benefits of the beneficiaries when they satisfy and achieve their age 65 and all that sort of stuff. The old Coles-Myer discount shopping vouchers, right? That was one of those things, was the benefit just came with the shares. And once it no longer came with the shares, then you couldn't have it. And so I think that this is one of the key issues, particularly as we address insurance needs of the members. And what you notice is that a lot of insurance products now come with health benefits. Of course, they do that because they want to make sure that people are living longer and staying healthier. And so they have a lot of these active programs that you get as an insurer. Now, that can come at a cost, as an additional cost from a premium point of view. And that might be looking after the non-financial benefits of the beneficiaries, but not the financial. And so if that's the reason you're choosing it, and it costs a little bit more to obtain that insurance, then is that in the best financial interest of the beneficiaries and the super fund? And that's the degree that we're going to start to get at as this new measure sort of takes effect from 1 July. And it doesn't preclude people from undertaking it. So it doesn't mean we can't have that insurance that has the health app that tells us to walk 5,000 steps in a day and we get some bonus points or whatever and make us feel good. But we still have to be addressing things from the financial side first. And that then extends to the point where we need to consider the appropriateness of the expenses associated with the fund. So your non-standard types of expenditure, where do they sit with where the financial interest is of the fund? Is it non-essential? Is it necessary? And if not, it's going to create greater scrutiny. And I've been on that little bandwagon around fund expenses ever since we got the draft ruling about non-arm's length expenses. We are monitoring the expenses of a fund far closer now than we ever did. And so this is one of those spaces where we need to be mindful that not only are all of our transactions on an arm's length basis, are they in the best interest or best financial interest of the fund undertaking those expenses, and any expenses to a third party, say for memberships and other things, are they necessary at all? And probably, I think it was a great article. I think it was Shelley Banton from ASF Audits wrote from memory, really good article recently about expenses in super funds. It was talking about subscriptions to both software programs, magazines, and various associations. And identifying that, were they or are they deductible in the superannuation fund? Well, now what we have to do is also address, are they in the best financial interest of the superannuation fund, not, where's the tax benefit associated with doing it? And of course, we'd always argue that the marginal tax rate is beneficial, more beneficial than the super fund rate anyhow. So look, quite a number of things from just a pure legislative point of view to contemplate. But compliance to me does go beyond the considering the risk, the diversification, liquidity, and other things. And it incorporates, so the investment strategy and what we're creating, it does incorporate our investment restrictions. So loans to members, financial assistance to members and relatives. If every investment strategy started with the simple words, my super fund cannot lend money or provide financial assistance to members and relatives, well, then it's in your face every single time. But yet it's still the number one compliance breach for self-managed superannuation funds is the provision of financial assistance, because it's too easy to access the money. But, you know, have loans been considered as part of the investment strategy? I think I gave you the example of my fund and when I went out in my own business, how I actually did lend money to the trust that was operating the business, because I reviewed the markets at the time and I looked at returns and felt that returns was down. I looked at I benchmarked against some interest rates, and I felt, well, if I make that loan to my business and my loan is paying me back at whatever the appropriate interest rate was, then I couldn't get that in other returns at that time. So to me, it was a transaction that was in my best financial interest for the super fund and my beneficiaries, because it was aiding my return. And of course, I also had to consider the investment restrictions around it being a loan to a related trust. And so being a loan to a related trust, it was an in-house asset. So all those sorts of areas, but I built it all into the investment strategy.
And I think that's the key, Tim. So you've considered it, you've gone through that whole process. It's then that final step of documenting it.
Yeah.
And if that's documented, that's great. Gets a tick for us as the administrators, because it's not for us to decide what the investment strategy should be or the appropriateness of it. It's more so making sure that it's actually a relevant and valid strategy. And then when the auditors look at it, they'll do the same thing. Again, they're not looking at how appropriate it is or whether it's a good strategy or not. They just want to see that it's actually a relevant strategy for the particular fund.
Yeah, correct. And that's a good point. And so again, similarly, the insurance restrictions, what can we and what can't we have in the fund? And a lot of that's going to come around your trauma and your TPD own occupation sorts of insurance, and knowing that you effectively are prohibited from now taking out those sorts of policies inside a super. And so make sure you understand that when you then consider the insurance needs of the fund and contemplate whether you need to split the insurance or whatever. And of course, again, always link back to the sole purpose test with what our actual end game is going to be, but also the operating standards. And I think this is the thing where we look at the SMSF admin penalty regime and we say, okay, well, there are specific penalties for certain areas, but one of the all-encompassing penalties is a breach of the operating standards. And the creation of the investment strategy and the consideration of all the requirements, risk, return, liquidity, all those sorts of things form part of the regulations which link back to the operating standards. So if you have a set and forget investment strategy, if you have an off-the-shelf, non-descriptive investment strategy, then arguably you're in breach of the SIS regulations. And from an admin penalty point of view, you may get an education direction from the ATO for a first offence. But if you then don't go and change your strategy to reflect the actual investments of the fund, well, then they're within their powers. And I think it's 20 penalty units. So that's just over $4,000 of penalties to the individual, not to the super fund or to the corporate trustee. So the operating standards start to come into the compliance of the investment strategy as well, as do the separation of assets. And sort of my highlight point then of what's to come is then this new retirement income covenant. So it took us a while to adapt to the insurance requirements and the need to consider insurance. Well, under the retirement income covenant, and I suspect that now in contemplation of the retirement income review that the government undertook, we will see more come out about this retirement income covenant, which is touted to kick off from 1 July 2022. Right? But the whole idea that we actually need to think about the retirement needs of each member, not at retirement, right? But well in advance of that. So we actually have to have an investment strategy for the plan to meet the objectives, and those objectives will have to have a link to the retirement needs of each member of the fund. So if you can fit that all into one page, good luck. The investment strategy itself is going to be a much bigger and broader document once we have to start contemplating the retirement income covenant, which realistically, when we're contemplating risk and return and all those sorts of things, should already be part of what we're trying to achieve, particularly as a member goes into to pension there. So what I would sort of highlight is that that's our I guess our technical concepts, those issues that we need to delve into, the covenants, making sure we're ticking off those boxes, but in a meaningful sort of way. And then it takes us or leads us into the practical side of actually creating the investment strategy. And again, I come back to that client with the gold, right? They did so much of what's required in this sort of outline here. They just didn't hit that final bolded word there, which is the documented part of it. And you know, history will show us why.
And well, I think, you know, and that's the thing we see the most is we see so much thought put into the actual investments, what the clients want to invest in. It's just that final step. They just see the investment strategy. Oh, that's a box we have to tick. So we get the template, we fill it out as best, we sort of fumble our way through it and send it back to the administrator. But it's just taking that next step to fully document those decisions that have already been made.
Yeah. So look, and so I think just to summarise those points specifically is that it should reflect the actual investments of the fund, right? Which means it is a very fluid document, because if your investments change, your strategy changes. So the idea that somebody has a non-complying investment strategy should actually sort of blow our minds, because the strategy should reflect what they're actually doing. And you know, the fact that they have thought about the process, just document it. It doesn't need to be, you know, a thesis. It just needs to identify why they're doing it and what purpose they're going to get out of it. So we know that they can change it as regularly as they want to, and make it achievable. So we'll talk through the steps in a moment of how to get there from an investment strategy point of view, but it needs to be achievable, as we've touched on already, regularly reviewed. But as Tom highlighted a couple of points, death of a member, adding and reviewing new members. Certainly, if new investment opportunities come along and it's not contemplated inside the self-managed fund, is another area. Changes in the SIS legislation. And you know, I think limited recourse borrowing arrangement was probably, for me, the one time in the SMSF industry that we saw meaningful changes to the way that investment strategies were written, because you know, we had to contemplate borrowing. And so, you know, the reason of LRBAs without a history lesson is to talk through Telstra 1 and Telstra 2 and all those sorts of things in instalment warrants, and then we evolved to limited recourse borrowing arrangements. But no one really contemplated borrowing under their investment strategy with T1 and T2, right? It wasn't until instalment warrants under the limited recourse arrangement came in that we saw a greater emphasis placed on the investment strategy and how things were worded. And so we've already got history. And of course, there was always early adopters and people that were far more thorough in their investment strategy. Let's not say that it was a complete industry problem, but there were certainly lots of pockets of it being one of those areas of, well, everyone's pretty comfortable that it's your money, so you can do what you want with it as long as it's within the rules, and the documentation is kind of just a process, but not necessarily a huge issue. But that LRBA bit was certainly where I saw the first sort of significant piece of change. So, and look, the one point that I wanted to put on there is that the strategy and any review requirement and your objectives should be documented. Well, one of the questions, having presented for so many years on so many different subject matters, and also being in admin for as long as I have, is this idea that nowhere in the legislation does it say that the investment strategy needs to be in writing. And that's correct. But so
it does make it hard from an audit perspective to check off that they've got an investment strategy. if it's not actually in writing, though.
Correct. Look, and look, I think probably my most enjoyable investment strategy that I ever saw was a fund that I dealt with many years ago now, and the auditor requested the investment strategy for the fund. They said, we need to see your investment strategy. So the client sent an envelope, a sealed envelope, with strict instructions to the auditor: please do not open this envelope. This envelope contains my strategy and it's for my eyes only. But rest assured, it is in the envelope. Needless to say, I suspect the auditors opened the envelope, but it was one of those areas where the trustee felt that he didn't want other people piggybacking his investments. Right? That's a good mindset to have, but really what the auditor wanted was justification that you had a process behind the various investments that you hold in the super fund. So really, despite what the legislation says, the ATO say it on their website, it should be in writing. I read should as, please put it in writing. It just makes everybody's life a lot easier in that regard.
And again, coming back to that documentation, diversification is another one we quite often see as an audit issue, that, say the funds are 100% in listed investments, or it's 100% in property, and property is probably the main one. Yep. And just putting in that note in the investment strategy to say, well, I have got diverse investments, because they might hold other investments outside the fund, and they want to hold the property in that particular vehicle. So just those sort of comments in the investment strategy can make all the difference in just speeding up the audit process as well. Yeah,
correct. And look, and I think, and I attended another presentation recently, and they talked about the ideology behind people with 2 self-managed superannuation funds. And there being this sort of hearsay that people were doing it for transfer balance cap purposes. But, in digging a little bit deeper, what these people had found was that a lot of people were doing it to, in effect, segregate risk, right? So whilst we can segregate assets inside the self-managed super fund, and I'm not talking about from an ECPI point of view, I'm talking about from a member and investments sort of specific basis, by removing sort of investments that were maybe not aligned with the existing investment strategy and maintaining them in a separate fund, was effectively, saving that other fund from the potential woes of this potentially risky investment. And so there's all sorts of different thought process that come into it. But of course, all of it, and what a lot of this comes back to is these 2 words here: meaningful and measurable. And that is that if you've got an objective, then your objective's got to have some meaning, and that is you want to make sure that you can provide a certain level of income or whatever once you hit retirement, and then you have the capacity to measure it. And we're going to touch a little bit on asset ranges and that in a moment. But are asset ranges, and this is sort of not necessarily a question, but we'll raise it in a moment, are asset ranges the way for us to address that? And I know that Tom and I certainly have got some old school views on that, but we're also willing to accept that the times they are changing, and we need to address that. But not only is it got to be meaningful and measurable, but you've got to be able to justify the decisions and use the investment strategy to justify it. And then I think a key issue that is certainly talked up in this best financial interest duty requirement from the covenants, and that is that the Section 55 of the SIS Act is occasionally talked about, but not really well known, and that it provides the capacity for trustees or for anybody to take action, or the beneficiaries to take action, where anybody has acted outside the requirements of the covenants and you have suffered a loss or damages from that transaction. So a very broad, basic, non-factual, off-the-shelf investment strategy. You could argue both sides of the equation there, that you've made decisions outside the investment strategy because you haven't specified what sort of investments the fund is going to undertake. And so if they're done on some form of discretionary basis, or one trustee undertakes it without contemplating the other trustees, then you've got the capacity to take action against that trustee, against some other professional that's engaged in that conversation. And so hence, there's far greater benefit in identifying the types or the asset styles that you want to invest in to meet your objective. Because if you do that and then you fail, Well, there's no recourse against yourself or other parties, but you can live with it because you've thought about it and you've contemplated it, and it's part of the overall strategy of the fund. And I think that's one of the areas that people need to be mindful of. So our objective sort of sets out where the client wants to be, and the strategy is how they're going to get there. And that's the way I like to sort of identify between the two. So if we look at the objectives, we look at our assets outside and inside of super, how long we have until retirement. We need to consider the respective risk profiles. And I know that, we touch on our template a little bit, but we've got a guide there for trustees to try and identify what their risk profile is. And I think that can then help them in determining, or at least speaking to somebody qualified on the various investments about where those investments would sit in the risk profile point of view. What levels of income do people want? All these sorts of things will form what the objectives are. And then, are your expectations realistic? If you've got $100,000 in super, well, then you can't expect to be paid $20,000 income every year once you hit retirement if you're 64. So you've got to try and say, okay, where am I at? Where do I want to be at? What do I need to do to get there? What sort of contributions can I make? And all those other sorts of things that are linked in. And so if you've got an objective which is achievable, given those risk profiles, hence the requirement to really look at it, then there's going to be less need for intervention and remedial action, right? And less need to change it. And so, I think that's why historically the set and forget, or the rubber standing, the ticker box, ticking a box, all those cookie cutter, all those words that we use to refer to investment strategies, it's why sort of people left them very broad, because then it said, well, that gives us the opportunity to invest in everything, but you didn't actually have an objective in place to get there. And probably that leads to one of the comments that I know often gets asked with regards to investment strategy. And that is, people will say, well, do we need an investment strategy if we've got a statement of advice? So what role does the statement of advice play? And I know you've got some sort of comments on that situation or that position, Tom.
Yeah, I think it's a great starting point, the statement of advice. And the next step following that is then putting that investment strategy into place.
Yeah.
So the statement of advice is obviously what the advisor is saying, well, this is what we think is going to work to get you to meet your goals. And then it's up to the trustee to then say, okay, well, I'm going to put that in place by putting that into an actual investment strategy and document it appropriately. So again, it's a lot of the time, the initial step is taken.
Yeah.
It's just that final step to put those things in place.
Yeah. Okay. Yeah. And I think that's the thing. So the question, can I just have my statement of advice as the investment strategy? Probably the answer to that is no, because that is advice being provided by your financial professional to you as members about how to achieve your goal, and that will often contemplate other things outside of the super environment, but it will at least give you guidance towards some of the key issues that you need to address when creating your own investment strategy. So I think there's some good points. So then we've got our objective. We then need to create our strategy, and it's our plan for achieving the fund's objectives. So I've identified this as two options. Right, you've got option one, and ultimately there's multiple options, but these are the two clear-cut scenarios, and that is you set asset allocation. Now, the ATO identified this as a percentage or a dollar figure. Dollar figures are always a little dubious, because that's always going to be changing in that regard there. And then the concept is that you remain within a range. Now, to remain within a range is very difficult from an SMSF point of view, because it's a non-reporting entity, in the sense that, unlike an APRA fund, you're not having to report or report back against the investment strategy. So some of us might suggest that the asset ranges are not the most appropriate. But I think that's because, and I think I may have convinced you to agree with me on this one, Tom, but I think that's probably because often the ranges are too wide.
I think that's the thing. And using ranges, my issue with it has always been, there's no real thought put into it.
Yeah.
So 0 to 100, and the ATO's come out and has for a couple of years now and said the 0 to 100 is not appropriate.
Yeah.
But even 0 to 50, these sort of wide ranges, I just don't think that they actually are really meaningful.
Yeah. And look, and I think, and again, I reiterated the point that where I saw value in these, or where the industry saw value, was when we had compliant pensions in the early 2000s, because the actuary had to sign off on an annual income requirement based on return. And the only way that the actuary could make a determination as to what the income was, or what income was actually able to be paid, had to be based on a net return, based on like a high growth, stable, balanced, whatever, and low return investment strategy. And so therefore it was interesting to reflect on the investments each year. Now, of course, what most of the time would happen is you have this long-term strategy, which the income was based on, and then every year the ranges would be out, but you would wonder why the reserves were diminishing. Well, it's because you hadn't invested in high enough growth assets or whatever to manage the expectation of the actuary. So yeah, the range thing, I think, is a good guide for people to contemplate as to, if we've identified that we want to deal with listed securities, we want to have some property exposure and that, then it gives you a bit of a guide if you want that diversification. But alternatively, you can avoid ranges so that you don't have to have ranges in your investment strategy. But if you've got material assets, then you need to be able to identify those material assets in the strategy and how they will help you achieve your objectives. And again, that gold example is the classic sort of situation, hedging against cash rates and all those sorts of other sorts of things there for it to be considered. So short-term variations are certainly not an issue or anything that we need to be mindful of. So in summarising all of that, you obviously, as I said, you set your strategy, you think of the risk and return, the diversification, the liquidity requirements and all that. And ultimately, why don't we have these as our headings? Why don't we actually create in the investment strategy these areas and how we are addressing them with our current investment strategy? So I think, a lot of the strategies that have evolved over time now are starting to address these issues a little bit better, and certainly have headed down that path. And so from a diversification point of view, can we take all that sort of stuff into consideration and then effectively ignore it? And the short answer is yes, right? So can we have a single asset strategy where our liquidity and those sorts of things are compromised? Of course you can, but document it. And that was the whole 17,500 audits that the ATO sent out, or letters, the Please Explain letters to all those LRBA funds operating, where they only had the LRBA effectively in place. The point was, have you considered the diversification risk or the lack of diversification risk? Have you documented it? Because if you haven't, then you are subject to these penalties. Now, they came in all heavy-handed on the penalties in that letter, in that communication, but the message was right. The message was, are you doing the right things in this thought process? So I was actually, relatively comfortable with where the ATO sat there. And statistically, what the ATO numbers sort of show us is that there is a fairly high percentage of funds, particularly with lower balances, where there's a high concentration in a single asset class. And so it's an area that we do need to be mindful of, is that particularly in the SMSF space, we have a tendency to focus on that one asset range, which is not a problem, but how have we addressed it in the investment strategy of the fund? And if we look at 2020 in the review mirror, one of the issues there is I liken pension payments to the 2020 toilet paper fiasco in Australia. And for want of a better term, is if you plan ahead, right? If you apply your 2-year income rule, then you don't need to draw down on the capital of the fund. If you have enough toilet paper, you will survive a weekend without having to go and raid the supermarket shops. And so I think linking toilet paper and what represented 2020 with our investment strategy, kind of quirky, given I started off with a toilet block investment.
We can also link 2020 with the toilet paper in other ways.
Yeah, well, correct. But by having that sort of image there of the short term, we need this, were pension payments actually the issue of 2020? And I don't think it necessarily was. I think it was that we hadn't represented funds via their investment strategies appropriately to be able to deal with situations like a loss of income from rental incomes, like a loss of dividends from certain companies and all those sorts of things, because we've always had this strategy where we'll get the dividend and that'll pay our pension. And so we haven't planned ahead for it. So, to me, that whole global strategy thing is something to be mindful of. So to finish that all off for you, I guess the key points of the investment strategy conversation, and really what we were wanting to do is emphasize the conversation points to be having with our clients, with your clients, and even for yourself with your own funds, is that you've got to have the strategy and it's got to be in accordance with the covenants. That's a no-brainer. Should always and should really reflect the actual investments of the fund, but can be changed as often as needed. The regularly reviewing bit, I remember the very first time that rule came in and somebody wouldn't sign their financial statements because we had a declaration in the financial statements that said, I have reviewed my investment strategy. And I said, well, I haven't reviewed my investment strategy. We said, well, have you looked at your investments? And they said, yes, we have. So we've reviewed your investment strategy. So, you can play on that as you will, but it's clearly an important issue. But of course, the objectives, the strategy, the review process, and any changes should most definitely be documented. So, look, that brings us to the end of the presentation. Tom, thank you for joining me. I just want to the floor. If anybody's got any questions, please put them in the Q&A box. If not, we will take your silence on board. We will issue a copy of the presentation with the CPD points. And next presentation that we're delivering is actually on segregation. So I'm going to be touching on ECPI plus asset segregation along the lines of the investment strategy. And that will then lead into my following webinar on currencies, cryptocurrencies, collectible coins, and just the way we need to differentiate between various sort of currency-based investments in superannuation. So thank you for attending today. We've got no questions, so we will see you all next time. Thanks, man. Cheers, Tom.